I recently spoke with an investor named Lisa who was absolutely furious, not because her loan got denied, but because it actually closed. So she thought she was getting a 7.25% fixed rate DSCR loan. But by the time she looked at her closing statement, her effective rate was over 11% when she factored in the points, lender fees, and all the other items. And that's when she called me and said, Robert, I thought I knew what I was signing. And she's not alone. If you're buying or refinancing with a DSCR loan, today I'm gonna show you what these loans actually cost and how to make sure your deal still makes sense before you wire that down payment or sign the dotted line on your closing statement. I cover DSCRs and real estate financing every single week. So if you're serious about growing your portfolio without surprises, hit subscribe on our channel before we hop in. So to start out, let's discuss the base costs of a DSCR loan. Let's talk about what every DSCR loan includes. And I'm gonna hop over to the whiteboard here. So you're always gonna have to have a credit report on any loan, let alone DSCR. So you're gonna have to pay a credit report fee. Depending on the lender, that could range anywhere, I'd say, from $80 to $150 for a credit report fee. The next fee that you're gonna need to pay is an appraisal fee. We gotta have an appraisal on a DSCR loan. They're gonna be appraising both the property value and the rental income as well. The appraisal fees can vary depending on the property type and area of the country, but generally I see DSCR appraisals anywhere between, say, $750 on the low end, up to about $1,000 on the high end. And a side note is if you're getting an appraisal on a property that's like a 4 to 8 unit or mixed use, you might even go as high as $2,000 or $3,000 for those. But generally, you're gonna be in that $750 to $1,000 range for the appraisal fee. Next thing is gonna be the underwriting fee. Now the underwriting fee will vary by lender, but generally on DSCR, the amount I see on these is anywhere between $1,500 and $2,500 for the underwriting fee that's paid to the bank. And now the big one, we can't not discuss this, is your broker fee or origination fee. And this is money that's paid to your loan officer, your loan originator, to actually go through and get your loan done. And that can vary too, but generally on DSCR, 1 to 2% is usually what I see. If you have a more complicated profile, more difficult loan, it might be a little bit more. If you're doing a lot of loans with the same broker, maybe they'll charge a little less, but on average, 1 to 2% is what I see there. And then lastly here is gonna be points, discount points. This one's really important. Discount points are prepaid interest that you can pay to lower your interest rate. Sometimes it's worth it to do this, sometimes it's not. When I see people pay points, it's usually between 0.5% to 2.5% that can go towards lowering the rate. But again, sometimes it's not worth it. So how do you know? You need to run a break-even analysis on the points and the recoup time. And you need to ensure that the recoup timeline is longer than you plan to keep the loan. So for example, if you have a break-even point of 2 years, but you only plan to keep the loan for 1 year, then it doesn't make sense to pay the points. But if you have a break-even point, let's say of 2 years, and you plan to keep the property for 5 years, then it could be a good decision to pay points. So what is the break-even point? How do you calculate that? Well, real quick, I'll show you. You're gonna take the cost and you're gonna divide it by the savings. So if it's saving you $50 a month and it's costing you $2,000, you're gonna figure out what the time is, that break-even time, and then you're gonna be able to determine whether it makes sense to pay those points or not. So the other charges that you wanna be aware of on a DSCR, or really any loan for that matter, is gonna be your title charges, prepaids, escrow, all that stuff. Okay, third-party fees. So depending on where you're at in the country, title charges, that could range anywhere, I would say, from $2,000 to $3,000. If you're in an area of the country that's higher cost or you're getting a higher loan amount, over $500,000, it might be more like $3,000 to $4,000. But for most, $2,000 to $3,000 is a good amount to have to understand that's going to be charged for these third-party and title fees. The next thing is going to be your prepaid items. Prepaid items going to be your escrow, your taxes, your insurance, things like that, okay? So that can add up. It can add up to several thousand more dollars. It's really hard to say. I would even say 4,000 to 6,000 on these prepaids, but it depends on where you're at in the country and how much the taxes are, how much the insurance is, and whether you're including the escrow or not in your loan. If you're not including an escrow account in your new loan, then you won't have to pay most of these other than some prepaid interest. But if you are including tax and insurance, like many investors do, then be prepared to fund these escrow accounts with several $1,000s. So how do you know what the fees are going to be? How do you actually budget ahead for this and know what you're getting into? Well, unfortunately, or fortunately, depending on who you ask, DSCR loans don't have a disclosure requirement. They don't have a loan estimate or a TRID requirement like a government-backed loan or a conventional loan. So you're really gonna need to dig in with your loan officer about what their fees are, or you can prepare to be blindsided when you find it like Lisa did at the last minute. If your lender isn't being forthcoming with this or isn't giving this info to you early in the process, that is a huge red flag, and you definitely wanna look to deal with another lender or get a second opinion. Now, the next cost to be aware of are the DSCR specific loan level pricing adjustments. And this is where things get really interesting because like some other loan types, DSCR lenders often add risk premiums to offset higher risk loans. I'm talking about a rate bump. So if you have a short-term rental property, a really low DSCR ratio under 1, maybe you're cashing out equity, or you're trying to finance a property with a lot of units like 7, 8, 12 or more units, you're gonna have a risk premium for that an additional risk that's taken on. That can bump your rate anywhere from a quarter point to a point or even 2 points higher for that extra risk that's being entailed. Another thing to realize about DSCR loans is the reserve requirement. So the reserves is money that you'll have left over in a financial account after closing. So after your down payment, after your closing costs, this is money the lender wants to see left over. And depending on the program and lender, this can be anywhere from 3 to 6 months of your principal, interest, tax, and insurance on the property. And it could even go up to 12 months I've seen with some lenders. So understand how many months of reserves that you need and plan accordingly. Now, one of the cool things about DSCR loans versus other loan types is that on a refinance for DSCR, we can generally use the cash out that you're receiving towards that reserve requirement. No other loan type can do that, which makes it a lot easier to qualify for a DSCR refi than another type of loan. Another big one that I want to spend a minute talking about is prepayment penalties. So these are penalties that you have to pay if you pay the loan off early. The standard DSCR prepayment penalties can be anywhere from 3 to 5 years, and they generally are offered in both a standard prepayment penalty as well as a declining prepayment penalty. So let's talk about the differences on these. So here is the DSCR prepayment penalty. So on a standard prepayment penalty, it's generally going to be a 5% penalty on the loan for the entire period. So if it's a 5-year prepay standard, it's going to be a 5% penalty if you pay that loan off anytime during the 5 years. So if you pay it off in year 1, it's the same prepayment penalty percentage as if you pay it off in year 5. And it's based on the outstanding principal balance on the loan. Now, what I like is the declining prepay. So declining prepay, every year it goes down, 5, 4, 3, 2, 1. So it starts out at 5%, much like the standard prepay, but then in year 2, it goes down to 4%. Then in year 3, it goes down to 3%. Then in year 4, it goes down to 2%. And then the last year, year 5, it goes down to 1%. So the longer you keep the loan, the less of a penalty that you have to pay. Now, this is applicable in most states, but there are some states, for example, Pennsylvania, that don't have prepayment penalties allowed on smaller loan amounts. So the reason why prepayment penalties are effective is that they help keep the loan costs down and they keep the rate down. The reason why is because by putting these penalties on the loan, the investor, the secondary market knows that either you're going to keep that loan for the whole period or you're going to pay the penalty, so they have certainty on their investment in your mortgage. And this is why you'll see a lot of the time you can get at least a 1% lower rate by taking a prepayment penalty versus not taking one at all. If your lender's not explaining this to you, it might be time to find someone new to work with. And many investors forget about this altogether. Even if the rate looks good, you need to know the loan structure. because the structure of the loan, these penalties can completely wipe out your profit and eat your returns if you're not careful, or if you just don't understand the terms of your loan. So let's go back to Lisa's deal and talk about real world math. She borrowed $400,000 and she borrowed that on a short-term rental property. So her rate was 7.25 with 2 points paid, which was $8,000 that she paid in fees to get that rate. Okay, 2 points was $8,000. She also paid a broker fee of 1%. That was another $4,000. On top of that, she had title fees of $2,500. And then on top of that, she had the prepaid, the escrow items we were talking about. That was $5,000. So you can really see this adds up. When you add all that up, it's almost $20,000 that she was paying in fees to get this loan to close. But the most important fact that she found out later is she could have completely wiped this fee. This $8,000 fee could have been completely wiped out if she just would have taken a rate of 7.875 instead of the 7.25. Now, since she planned on paying this house off or actually selling this property in just a couple years, she's never gonna be able to break even on the $8,000 in fees. She's never gonna recoup those points. So the lesson here is always calculate your break-even cost on the points and make sure that you're gonna have enough time to break even on your investment. So let's dive into talking about how to minimize costs on these DSCR loans. How do you get the best terms? Well, first of all, shop by APR, not just the interest rate, because the APR is gonna tell you the total cost of borrowing, not just the interest rate that your payment is based on. Ask your lender for par pricing. Most lenders are gonna show you a rate up front that is anywhere from 1 to 2 discount points, sometimes even more. So what you wanna do is you wanna request a quote with 0 points so that you can compare lenders evenly. Make sure you're comparing a 0-point rate from multiple lenders so it's apples to apples. You want to ensure you're working with an investor-focused lender or broker because they understand the nuances of these DSCR loans. They can structure the deal smarter for you, especially if you've got a unique scenario, lower credit, short-term rental property, or anything like that. Always get a second look. Before finalizing your loan terms, get an experienced investor-friendly lender like myself to do a review of the offered loan terms and costs to make sure that you're getting one of the best deals in the country. Final takeaway here for you. DSCR loans are still one of the best tools for scaling your real estate portfolio, but they're only great if you understand the real math behind them. So when you know every fee, you stay in control and you're gonna make a better investment decision for yourself and your real estate portfolio. So if you want my free DSCR cost breakdown checklist, go ahead and hit that link below. This is the same sheet that I use with my clients before every transaction. And if you want help analyzing your next investment property, schedule a consult with me and we'll make sure that you know the real numbers before you close.